Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier and Mayer Research, LLC, the providers of Investors Monitor and InvestorsMonitor.com, as well as our various investment publications, including Frazier Strategic Allocator. In this week's video, I'm going to talk a little bit about the upcoming Federal Reserve meeting this coming Tuesday and Wednesday, November 1st and 2nd, and give you my opinions on what I think the Fed's going to say and do regarding its monetary policy, its interest rate decisions, if you will. And I'm also going to cover a little bit more on the type of information that's available on our internet website that I'm confident that if you go to on a regular basis and you read our monthly investment journal on a regular basis, as well as our weekly commentaries and our trade alerts that we issue, I'm very confident, very confident that you'll avoid all of the major downturns in the financial markets, that you'll participate in the majority of the upturns, and that you'll invest in the right sectors, ETNs, ETFs, and stocks, all of those, at the right time. So, first, a little bit about the upcoming Fed meeting. Well, you know, oh my gosh, it's probably been a year and a half now that we've had on a regular basis, anytime that the Fed is getting ready to meet and discuss monetary policy, and to announce an interest rate decision, we've had for at least a year and a half now numerous so-called financial market experts claim or say or think that the Fed's going to raise rates. And we've also had numerous Federal Reserve presidents, that is, presidents at the 12 Federal Reserve banks over at least the past year and a half, also say that they thought interest rates needed to be raised. You know, for a year and a half, they've been saying this over and over and over. And yet, I've been telling our clients and subscribers for also at least a year and a half, if not longer, that there's no way the Fed was going to raise interest rates because there was no reason to raise rates. I mean, there's only one reason to raise lending rates in the United States or any other country, and that is if inflation's getting out of control, or looks like it's going to soon get out of control, and that we need to slow down economic growth to contain inflation. And well, quite the contrary is going on, as it has been for at least a year and a half. And that is, we're in a very sluggish economic environment. We're in an environment that, well, yeah, I'm just repeating myself, that the U.S. economy, as well as most other economies around the world, are just growing at a slow pace. And as I discussed in our the first relaunch edition of our monthly investment journal, Frazier Strategic Allocator, you know, we're continuing to see signs that the economy is going to continue to grow at a slow pace for at least the next few months. So why would the Fed raise interest rates if the economy is going to grow at a slow pace? Well, they're not. So I'm very confident that once again, this coming Wednesday, November 2nd, that the Federal Reserve is going to announce that it's not going to increase short-term interest rates, its overnight lending rate, that it's going to stay on hold. So now I want to show you a few charts, or at least a chart, of what does happen, or what has happened historically, when the Fed has begun to raise interest rates, and how stock prices in general have reacted during early stages of rate hikes. I'm then going to share with you some more information that's available on our internet website on a regular basis that'll help you keep up with what's going on in the markets, even if you don't read our journals. I think it's important to read our journals, but anyway, enough about that. Let's get into this. So let's begin by going to the home page of my firm's internet website, InvestorsMonitor.com. And For those of you that watched and listened to a video that I recorded last week, you'll know that I discussed some short, intermediate term, and long term investment timing indicators and showed you where you could find information regarding those indicators, at least charts of those indicators on our internet website. So let's begin by reviewing very briefly where those indicators are posted on our website, or at least charts of those indicators. And first, so we want to go to timing monitor, and we come down and click on buy sell index, and this is an indicator based on a investment timing monitor that I created back in the late 1980s to help me forecast the direction of stocks in general. When I say stocks in general, which I'll say often, I'm really talking about the direction of the overall U.S. stock market primarily, and I generally use the S&P 500 index to represent stocks in general, the U.S. stock market. And so I talked about this last week, and but you should go here on a regular basis and just see, even though we're going to tell you in our monthly investment journal whether or not we get a new buy or sell signal, buy signal, sell, buy, here, sell. We're going to tell you in that monthly investment journal, or in our weekly commentary, if it comes out in between our monthly reports, whether or not a new buy or sell has been recorded on our buy-sell index. But you still should go here, or I'd encourage you to go here every Sunday to our website, to this page under Investment Timing Monitor, Buy-Sell Index. Take a look at the chart and just read our latest comments, which we update every Sunday. Next, I talked about last week our Relative Strength Index, and this is just another chart I think you should take a look at every Sunday. We only update it once a week, usually on Saturdays, or at the latest on Sunday of every week. And we'll post comments regarding what our research is telling us regarding this stock high relative price strength index. Thursday, I don't know what I was going to say. Next, our sector performance charts. This is really a short-term timing indicator, which I talked about once again last Wednesday, October the 26th. And but every week we post comments here on our latest analysis of what's actually going on in the U.S. stock market as far as sector rotation is what it's commonly referred to as. The blue line is our sector performance index. The black line is the S&P 500 index. And as you can see, they generally move in the same direction. So here, moved lower. The S&P 500 moved lower. Here we got a little bit of a rebound. Here we got a tiny rebound. But now in the latest week, this is heading lower again. Suggested short term, the stocks in general are probably going to move lower over the next couple of weeks. And then lastly, our overbought, oversold indicator, which is a very short-term stock market indicator, and which I talked about once again during our October 26th video. And but every week we update this chart on. We often don't post it to our website on Sundays, so probably you should check on Sundays of every week in the early evening to make sure we have it there. And we'll tell you what our analysis is of what this indicator is telling us. So let's go back to the home page. That's enough on that because we already discussed these indicators in our October 26th video. But today, what I want to do first, talking about the Fed, I'm going to come over to this econ monitor. Let's go about this way. We'll come up this way. Econ monitor and economic and fundamental stock market indicators. Click on that, and we have, I don't know, it's probably 100 charts at least that we update on a regular basis, as well as, excuse me, the underlying data that we use to create those charts. And if we scroll down here underneath coincident indicators to interest rates and click on the effective Fed funds rate, the overnight lending rate, that is the interest rate that the Fed always talks about in its statements regarding its monetary policy, and that is interest rate decision. And if you see here, if you look at this chart closely, you'll notice that generally speaking, let me slow down. The blue line is a chart of the effective Fed funds rate, the overnight lending rate, the rate at which banks lend to one another on an overnight basis. That's the rate the Fed always talks about in its meetings. That's what the blue line is. The black line is S&P 500 index. And if you look at this chart carefully, you'll notice that during early stages of rate hikes, look what happens to the S&P 500 index. It keeps going up. Or it goes up. I don't know if I should say keep going. It goes up. It doesn't fall. Only until we get to high levels in the overnight lending rate does the S&P 500 turn lower. I mean, that was the case here. This is way back in the 1950s. It's the case here. Here's the Fed funds rate. Here's the S&P 500 index. The case here in the early 60s until I got to a really high level, did stocks move lower? And then we'll move forward a little bit. And during the 1980s, during the early stages here, well, I guess here it was moving lower. I take that back. But from here, when the Fed kept raising, S&P 500 went up until we got to real high levels in the Fed funds rate. So, my gosh, I mean, it's just consistent. During the early stages, rate hikes have no negative factor with stock prices. So, once the Fed finally does decide to raise rates, well, in my opinion, there's little chance that stocks are going to fall sharply. They'll probably fall for a day or two as a result of the nonsense that we hear on these broadcast financial shows, and the nonsense that we hear from so-called financial market experts that warn about how it's going to be such a terrible thing that the Fed raise rates. And the fact of the matter is, well, why would the Fed raise rates? Well, it's going to only do so, in general at least, once again, if the economy is growing at a fast pace or if the economy is picking up steam, there are inflationary pressures. Well, during early stages of accelerating economic growth, the early stages of accelerating economic growth, inflation is usually not a problem. So why would stocks fall if inflation is not a problem? Because the interest rates, the early rate hikes, they're not going to slow down the economy. The Fed starts raising rates only because the economy is picking up steam. It's growing at a faster rate. Well, we want the economy to grow at a faster rate. If the economy grows at a faster rate, businesses will likely hire more people, so people have more money to spend. Businesses sell more products and services. They have more money to spend and invest. And therefore, companies in general, their revenues go up. And as long as they keep their costs in line, their profits generally go up. So I wouldn't be concerned at all about any early interest rate hikes. Once again, we'll probably see a sell-off for a day or two, or maybe in a few days. Now, having said that, the current situation is a little bit different. And therefore we might see a problem if the Fed were to raise rates. And I say that because I think there's a lot of indication that the only reason that stock prices in general have held up is because the Fed has kept lending rates at such ridiculously low levels. But I don't see a prolonged sell-off just on early stages of interest rate hikes. I don't think that's going to happen. Okay, enough about that. Let's go back to our home page just to have a good starting point here. And now what I want to do, very briefly, is just share with you some other pages on our website where I encourage you to go on a regular basis. Not on a daily basis. There's some items or some pages that have daily information, but right now we'll get into that during future videos. But these timing indicators, well, they're only updated once a week, on every Saturday or Sunday, usually posted on Sunday. So no reason to go to our site every day to check those. It's not going to change except every Sunday. And a few other items that you don't need to go to every day. Probably once again on Saturday or Sunday. Might as well do everything on Sunday since these charts usually are not posted until Sunday. So once every Sunday, I encourage you to also go to our chart of the week. Whoops, we'll come up this way. When we do this, other drop-down menus appear. So we'll go this way, our chart of the week. And what you'll see here, so last week, we'll post another chart this week when we have an important indicator, give us some important information regarding the likely future direction of the economy and stock prices. But if you click on any of these, what you'll see is what we consider to be a chart of the week. That is a chart of a significant economic and stock market indicator. And our latest one that we posted last week was on the University of Michigan Consumer Expectations Index. And if you look at this chart, the blue line is the University of Michigan Consumer Expectations Index, and the black line is the S&P 500 index. And all of our charts, or at least the majority of them, the blue line will always be a chart of the indicator, the black line will be a chart of the S&P 500 index, and you can, without doing any statistical correlation studies, mathematics studies, and using programs or using some type of computer program, you can just look at the chart and kind of get an idea of what the correlation is. Not necessarily cause and effect, but definitely correlation. And what I mean by that is, well, look, when this consumer expectations index peaks and goes lower, S&P 500 index peaks shortly thereafter and goes lower. When it bottoms and goes higher, S&P 500 bottoms and goes higher. Here again, it peaks shortly thereafter, the S&P 500, that is stock prices, tend to move lower. It bottoms, guess what? The S&P 500 bottoms and moves higher. And this is a leading economic indicator. As I said in last week's video, as well as in our webinar that we held recently with Weiss Research, those of you that signed up to Frazier Strategic Allocator via Weiss Research. Now our focus is on the leading indicators, not on the coincident indicators. We want to know what's likely to happen in the future. You can only make substantial money in the financial markets, or at least in the stock market, by forecasting accurately, more often than not, what's likely to happen in the future. So we focus on leading economic indicators, and this is a pretty reliable leading economic and stock market indicator. As you can tell here, it peaked before the S&P 500 peaked. It bottomed before the S&P 500 bottomed. Well, what's going on here? Trending lower again. So stocks are probably going to move lower. And we don't just give a chart of this in our chart of the week. We don't just give a chart. We tell you the specific data, the trend, which you can see on your own, and our analysis of what the chart's telling us. So I encourage you to go here once a week, every Sunday, to see what our chart of the week is. Next, if you could do a daily basis, but really once a week is enough, to go back to the timing monitor and click on investment environment, not click on that, click on investment environment, the current investment environment. And we give a real brief analysis of our interpretation. I don't know why that's not loading. Let's try that again. There we go. Of both the fundamental and so-called technical timing analysis of the current investment environment. We update our comments here every Sunday. The overall current investment environment, updated every Sunday, this page. The fundamental environment and the short-term trading environment. And if you go back up here to timing monitor, put your mouse over investment environment and click on investment environment rating. This is a rating that we assign to the overall investment environment that can be from the lowest level is 0, which means it's just a horrible, horrible environment. There's no way you should be in stocks. Or 10 is the highest reading, which means you should be fully invested in stocks. And right now you can see it's a 3.5, less than 5. So at least our analysis of what's going on in economies around the globe and in the markets in general, this is telling us you should only have a small allocation of your financial market portfolio to stocks. You should be mostly out of the market. I think that's probably it. I feel like there's one other thing. Yes, there is one other thing. So lastly, I'm just going to go back to the home page again. So in this week's video, I talked a little bit about the upcoming Fed announcement on Wednesday, November 2nd. I reviewed some of our short, intermediate, and longer term investment timing charts. I've now talked about the chart of the week, the investment environment rating, and just comments on the environment. And lastly, also, it's important to keep abreast of what's going on with corporate earnings. I mean, the level and direction of corporate earnings, which is determined for most companies very largely by economic environments, but not always, not for all the companies. But we shouldn't just go by the economic environment and economic statistics. We should actually review and see what's actually going on with corporate earnings. And you can find earnings results on our website by going to our earnings monitor, come down to earnings results, and just find the particular quarter. Currently we're in the third quarter, and we try to update this page every day. Sometimes, because of time constraints, it's not updated every day. We apologize for that, but we try to keep it updated. And what you'll see here is at least earnings results for any large and or closely followed U.S. publicly traded company. And I mean, the earnings, each quarterly earnings season, that is on a calendar basis, companies that report on a calendar basis, that is at the end of March, June, September, December, as opposed to in between calendar quarters. One of the early companies, and so oftentimes the first company to report every quarter, is Alcoa. So Alcoa reported its third quarter earnings on October 11th. So you'll see October 11th, 12th. You can just scroll up through here. You can bet that if it's a large and or closely followed company, we're going to have that posted here. And if you're looking for results of the company that maybe you own, I don't know what browser you're using. If you're using Firefox, you can go up to, this is Google Chrome. If you were using Firefox, you could go up to, there'll be a menu item up here. You can go edit, find. This is Chrome. You'll have, I don't know what browser you're using. You'll need to determine how to use the find button. But for Chrome users, we find it by coming over here on these little dots, way over here, clicking that, go find. And let's just say I wanted to find Yahoo, assuming that they've reported yet. Well, I just type in Yahoo, boom, it goes right to it. So you can go right to the company and see its quarterly earnings and revenues results. Here's earnings versus a year ago, revenues versus a year ago. We don't pay any attention to Wall Street analyst estimates, whether or not companies beat or fail to beat those estimates. And the reason being, well, first of all, there's no such thing as a consensus estimate. You always hear that mentioned on the broadcast financial shows. Consensus estimates. There is no consensus estimates. These analysts don't get together and come to a group decision. What it really is the average estimate provided by sell-side analysts at large or at least medium-sized Wall Street investment banking firms. And we don't care about those estimates. Why? Because generally our experience has been, at least I've been doing this for around 30 years now, these Wall Street analysts, their estimates seem to indicate that they do whatever they can to make sure that the estimate that they provide is going to come in a little bit lower than what the company actually reports. So then the media will say, such and such company beat estimates. All these companies beat estimates. We don't care whether or not they beat those sell-side analyst estimates. We care whether or not their earnings and revenues are higher than what they were a year ago. So that's what our focus is on. Go back to our home page, and I think I'm going to wrap this up right here. Let me get back to there. I don't think you need to see me again, so I'm just going to end this recording here. I thank you for watching and listening. I hope you learned something, and I encourage you strongly to tune into our show every Sunday. And as I said in our webinar with Weiss Research, if you happen to watch and listen to that, we generally record these videos every Saturday, and then post them to our website every Sunday. So you can check our website midday every Sunday, and they should be there, these internet TV shows. And those of you that signed up to Frazier Strategic Allocator via Weiss Research, my understanding is that Weiss will have its own internet pages for our service, and they'll post those videos on that site. So thank you for listening and watching, and I'll speak to you again next week.